Good morning, traders. Today is December 3rd, Saturday. This is the U.S. Real Estate and Rotational Modeling System video that's designed to keep you up to date with what we should be doing with our retirement account. And first thing I want to touch on is, let's go over here because I want to touch on the basics of what we do, okay? The basics of my analysis. Oops, wrong direction. Okay, let's come over here. So the outline of what I do, how this MENT service works for everyone is we use the rotational modeling system as a primary trend direction to ascertain risk conditions and how we want to allocate our money into the markets. Understand that we do not move against or trade against this system. This is the basis for what all of the analysis that I do is basically from a top down. We start with the rotational modeling system. This tells us how we're going to allocate our money. And ideally what we have is this week we have a this one doesn't look like it's been updated. But it has, okay? So we have a 10% stocks, 65% cash, 25% metals. We'll move it in here. And that's our primary allocation level. And then our alternate allocation level is 10% stocks, 90% cash, 0% bonds. So ideally what we're doing, ladies and gentlemen, is we're allocating how we're going to deploy our money. 65% cash, 10% stocks, 25% into metals. Metals are our hedge. They are performing very well right now. Cash, because we do not have any real upward trending mode in the rotational modeling system. And 10% stock still allows us to trade efficiently with a very low risk tolerance. If you take a 4% or a 6% or even a 10% loss on stocks, trading only 10% of your total allocation, that ends up being a 1% loss or less. Overall, because 10% loss on stocks at only 10% of allocation is only 1%. So the idea here is we measure our allocation levels based on the rotational modeling system. We set our expectations here. Then we go to the custom index charts and we take a look at the custom. I got to move these a little bit because it doesn't quite fit. We go to the custom index charts and we determine what's going on in the market based on these custom index charts. These tell us what to expect on a short and intermediate term basis. These give us a read of all the gauges in the market, what's going on with consumers, what's going on with the general market, what's going on with cash flow, what's going on with metals, what's going on with all different sectors. And this gives us our in-depth micro look at the market, determining how we want to try to potentially trade and what we want to get ready for. So I just gone through and created the custom index charts video. This is a roughly 40-minute to hour-long video. I go through a ton of data here. It's very, very important for you to understand what's actually taking place in the market, not just from a high-level measure like this, but from a macro level like this, but we also need to look at the micro level, which is the custom index charts. When we get into these custom index charts, we're now looking at a micro level. Next, we move into the watch lists. And the watch lists themselves help us determine from a weekly swing trading basis what is actually taking place and how we want to try to take advantage of sector swings. So that's the top level down. We start with the rotational modeling system. That generates our equity allocation levels and our expectations. Then we move to the custom indexes, which gives us a micro look, kind of a brick by brick look at what's going on internally in the markets. Then we take that information and move it back down into these live trades, the TT scanner hot lists, which gives us a sector by sector breakdown showing us where we have the opportunity. So this is why it's so important to understand that everything that we're doing is from a top level We measure and allocate our risk to protect capital and only trade when it's efficient. Then next level, we go to micro level, which is where we get a better feel for what's going on in the market and how the trends are actually setting up. Then we come down to sector analysis, and we can determine how we want to potentially deploy our assets efficiently into various market sectors, growth sectors, value sectors, core technology, and other sectors, so that we can try to capture some of these swing trades. Eventually, it goes all the way down to the live trades, which is a daily rotational and swing trading system, which gives you the opportunity to try to capture daily trades. Those can last anywhere from 2 days to 25 days or longer in some cases. But that's the whole concept of everything that's going on here. Now, our modeling system, our rotational modeling system is right here, has performed extremely well. What I want to point out here, ladies and gentlemen, is we are about to move into positive territory. Depending on what happens through the last couple of weeks here, we may see the rotational modeling system move into positive returns for the end of 2022. This is extremely important. If you have any idea what's going on in the world of hedge funds and managed money, most other accounts are losing anywhere from 15, 20% minimum to upwards of 50, 60, 70% if you were overly aggressive this year. The rotational modeling system is doing exactly what it's supposed to be doing. It's protecting our capital. It's making money. And look at this chart. I mean, this is just incredible. If you can see on the right side here, it's actually climbing almost to new equity highs right now. So we've withstood all of this. We've withstood all of this downturn. And in this basing formation, we are almost at new equity highs. Can you imagine? Can you imagine what it's going to be like to be at the end of the year and reporting the MENT Rotational Modeling System actually made money and rallied over the last 2 months of the year to new all-time highs, while everybody else was minus 20 to minus 50% or more? It's going to be a great year, and you need to pay attention to what's going on. Okay, so right now, hypothetically, the system is, not hypothetically, for real, the system is still in the same trend we've been in since August 31st, 2022. We are still 75% bearish and 25% bullish on the weekly. That nets us into a 50% bearish trend. We are holding our own. We are doing well. We're still making money here. We're losing a bit of money here. The system is performing extremely well. And we have the allocation levels of 10% stocks, 65% cash, 25% metals, an allocation level here of 10% stocks, 90% cash, 0% bonds. We are going to trade like this until the systems rotate. What's very, very important here is that we're starting to see some rotation. I was looking at the charts today. The financial sector is bullish. Transportation is still bearish. SPY has stayed the same, bearish, bullish. Let me zoom in here. E-mini futures are bullish weekly, bearish daily. Dow Jones has moved into bullish territory, which is a good sign that the Dow Jones might be leading. Gold and silver moved to bullish on daily. Crude oil moved to, this is weekly. I've got these backwards. It's actually daily over here. I'll fix that. Crude oil is bullish weekly, bearish daily. Bonds are bearish. Consumer staples are bullish. We're getting early warning signs, ladies and gentlemen, in the financial sectors, in the Dow Jones, in consumer staples, that the market is recovering and starting to move into more of a neutral bullish phase, which is why I expect a melt up. Watch my YouTube channel and watch my other videos, particularly the custom index charts video that highlights what I expect and why I expect it to happen. It's very important this week as we move into the end of this year and early next year. Now, the U.S. real estate is, and let me go to this one. Not that one, this one. I've got them out of order today. I apologize. So last Thursday, Realtor.com updated the data, and this is the graphs from those days. You can see that reductions are increasing again. They're well over 100%. Okay, so understand that everything on the market right now is being reduced. They're not being reduced by much. Prices, the dark blue line here, have continued to contract. They're very close to zero right now, getting closer and closer to zero. Price reduction count is increasing. The reduced share is increasing still. Days on market have stayed flat. What's happening here, ladies and gentlemen, average days on market is about 7 or 8 right now from the negative area where they were. I expect this to move higher. It's going to slide into a bit of a higher trend. Real estate conditions will continue to move lower. Modeled market demand is at minus 43% here, which means that the price factor has dropped considerably. This is over the last year. You can see we've gone price factor here is the blue line, and modeled market demand is the orange line or the gold line. You can see we're down into negative territory here, and we are trending downward on a weekly by weekly basis. It's been like this for many weeks now, since essentially October. We've been trending downward. Now, this is important to understand that we are seeing continued weakness in the market, which is not translating into any real appreciation in real estate. Now, real estate, let me come over here. And so here we have the next. Price trends are flattening out, moving downward again. U.S. real estate price reduction activity is trending to the upside again. This is, again, modeled data here. So we have reduction activity and reduction share of market. Reduction share of market is close to 100%. And we have here activity is climbing again, back into positive 15-20% territory. Real estate active listings change has moved back into positive territory. I expect this to move higher towards the end of the year, maybe up into the 10-15% area. I need you to understand that, if we get a big flood of foreclosures into next year, this would be my big concern, would be that we would start to see this level move up above 15-20% here with a big flood of foreclosures and people trying to dump out of the real estate market depending on what happens. We're not seeing that yet. We're seeing moderate, consolidation in new or listing activity. We're not seeing huge amounts of homes hit the market. We're seeing price reductions, yes. We're seeing price trend activity downward. We're seeing days on market and price levels contract, demand contract. But we're not seeing a flood of inventory, a big dumping. Once we get a big dumping of inventory in the market, if that happens, then we're going to see numbers really start to explode. And when I say explode, I mean we're going to start to see the bottom fall out of the market. We're not seeing that yet. And we haven't seen it. And as long as we don't see it, we might see kind of a solid, moderate meltdown. Nothing aggressive, just a more moderate meltdown. Okay, next, we're going to come, as I try to find it, right here. The heat rank has moved back down into flat negative territory. This is telling us that the housing market is not very hot right now. You can tell it was hot back over here for a bit. This was essentially a bump in selling activity. People more than likely trying to take advantage of the approvals that they had back before the Fed really started raising rates, getting in when rates were still at maybe 4.5% or 5%. So now you're seeing this moderate decline in heat rank. You're seeing tightness collapse. Tightness meaning that the market has gotten very weak. We're seeing downward price trending. We're seeing new inventory come on the market. There is no more support for the market. This is what's telling you, is basically the support is deteriorating. It's deteriorating quickly. This is the lowest level we've seen the past 2 years. And this is going to be a leading indicator telling us that essentially the market, the bottom is falling out of the market. It just hasn't shown up yet. Real estate inventory strength is at near the lowest level that we've been in the past 2 years. I need you to understand this little tick up is a moderate trend upward near the end of the year. Inventory strength is holding up because reductions have not really flooded into the market yet. They are weakening. I expect this to roll back over to the downside and start to move possibly down into the minus 10, 12, 15% range. This I expect to move down a bit further. The tightness rank could essentially move down into minus 80, minus 90, meaning that the bottom just continues to fall out of the market, and it could stay there for a while. It will fluctuate. This area here with the heat rank is likely going to move back down into minus 6, minus 7, minus 8 by February, March, April of next year and continue to weaken. Fed will have to raise rates. Don't take it the wrong way. The Fed may be moving in a softer rate increase, but given the strength of the U.S. economy and given what's likely to take place over the next year, the Fed will continue to probably raise rates at least 0.5%, I would think, for the next 2 rate increases, and then maybe fluctuate a bit more. Seller desperation index is relatively flat. It started to move up a little bit. So you can see here we're fairly flat. This means that we're not seeing sellers super desperate yet. We did see that happen back over here, which is aligns with our inventory strength back over here in July and August. When sellers start to become more desperate, 2 things happen, okay? Prices start to decrease considerably. We start to see a little bit more activity because as prices come down, certain people will start snapping up the houses. But it all depends on the real market dynamics and concern. If we get into a crisis mode, which may happen towards the end of next year, we'll see. But if we get into some sort of a crisis mode, we could see sellers' desperation skyrocket while inventory strength decreases, tightness decreases, and the heat rank decreases. That would be a basically, bombs away for the housing market. But right now, we don't have that. What we have is a little bit of inventory strength, a little bit of seller desperation, moderate heat rank, and we have tightness has declined, meaning that the bottom is moving away. There's certain bombs are falling in the market, but we're seeing generally no real indication of downward trending, extreme downward trending yet. We are in a downward trend, ladies and gentlemen. It is moving downward. Inventories stacking up. Foreclosures are starting to click back in. The market is very, very flat. The bottom is falling out of the market. Real estate inventory strength is much weaker than it's been in the last 2 years. And right now, we're looking for the next catalyst. What is that going to be? Is it going to be a transition through March and April with the Fed? Or is it going to be some sort of a catalyst event taking place over the next 4, 5, 6 months? Real estate moves very, very slow. What this is telling us is we're getting early stage breakdown of the real estate market in a downward trend. And that would mean that your REIT investments and your other investments in real estate could become more at risk. So pay attention to the fact that real estate is just not showing any signs of strength, whereas the U.S. market is flagging sideways, the equities market, and may potentially move into a moderate bullish trend here, a moderate melt up. When I say a bullish trend, meaning we could be, SPY could be back at, 434, 435, 436, maybe 440 by January, February, which most people don't believe is going to happen. Okay, share my research with your friends. Pay attention to what's going on. Follow me on Twitter, follow me on YouTube. My goal is to help you understand what's going on in the markets and how to protect your capital and assets. Right now, if you are invested in the markets, you should be safely in cash in the equities markets. And if you are holding on to any real estate with regards to an investment, as long as you're net cash positive right now, you're okay. The market is weakening. I do expect it to weaken further into next year. I do expect a moderate price decline next year, possibly 15, 20%. And it really kind of depends on what happens with overall demand and the Fed. So right now we don't have any real warning in real estate other than the fact that Prices are declining. They're still positive. Let me come back over here and highlight right here. So prices, this price factor right here, blue line, is still positive. Year over year, it's still positive. We haven't seen it move negative. When it moves into the negative territory, which means it's got to move down about 11% from where it is right now. If and when it moves down, which is very likely at this point into negative pricing territory by end of next year, then we could see the bottom really start to fall out of the market. Demand and pricing factors are not very strong right now. I would expect to see this continue to weaken over time, which will deteriorate the data on this chart. Reductions will go up, share of reductions will go up, days on market will go up, prices year over year increases will continue to deteriorate, and eventually price reduction share, which is this light blue line, will continue to move higher. But understand, that's still 12 months away. So right now, hold on to your shorts. The markets are trying to build some support, and we'll see how we transition into January, February, March, Q1 of 2023.